Okay, let's dive right in. We're going to tackle a really important and maybe even a slightly uncomfortable question for every Indian investor out there. Look, we all feel a sense of pride investing in our own country's growth. And why wouldn't we? But what if that loyalty, that patriotism, is secretly holding your portfolio back? Let's find out. This quote really just hits the nail on the head, doesn't it? This isn't about choosing patriotism or profit. It's about being a smarter investor. It's about taking a risk that's unique to us, the fluctuating rupee, and flipping it into a powerful global growth opportunity. So that's the big question we're unpacking today. We're going to move past the emotions and just look at the cold, hard numbers. We're going to see what a purely domestic portfolio really means for your long-term financial future. All right, first off, let's talk about a silent threat. It's something many investors completely overlook because it's not a splashy market crash or a bad stock pick. No, this is about the very currency your entire portfolio is built on. Just look at that number, negative 50%. I mean, that is a huge deal. That's how much the Indian rupee has depreciated against the US dollar in just the last 10 years. Let that sink in for a second. Your rupee today buys literally half of what it could on the global stage just a decade ago. And here's the direct consequence of that. You see, your investments might be doing great in rupee terms, showing really nice growth, but in reality, you're constantly fighting this invisible uphill battle. Your wealth's ability to pay for things on the world stage, for travel, for your kids' education abroad, even for imported goods, it's been steadily shrinking. So if that's the problem, what's the solution? Well, it's not about abandoning the Indian markets, not at all. It's still one of the most exciting growth stories in the world. It's about complementing it, about unlocking global growth to build a much stronger, more resilient foundation for your wealth. And the strategic answer here has a name: international diversification. Think of it as a game plan. It's a way to shield your portfolio from risks that are unique to India, while at the same time giving you a front row seat to some of the most incredible growth stories happening all around the globe. So what do you actually get out of this? Well, first off, it's a direct hedge against that rupee depreciation we just talked about. Second, you get access to these massive, high-growth sectors you just can't find at home. We're talking the big tech giants, the whole AI revolution, the green energy boom. Plus, you protect yourself from any domestic slowdowns or India-specific policy shocks. It's really just about building a smarter, tougher, all-weather portfolio. Okay, so that all sounds good in theory, right? But what do the numbers say? Does the data actually back this up? Let's take a look and see this global advantage in action. Now this chart, this is really eye-opening. Over the last decade, India's Nifty index has delivered a fantastic compounded annual growth rate, somewhere between 12 and 15%. That's solid. But then you look at the NASDAQ 100, which is packed with global tech leaders. It's been cruising at 18 to 20% a year. That performance gap, when you compound it over a decade, is absolutely enormous. So let's compare two portfolios side by side. On the left, you've got the 100% Indian portfolio. It's got higher concentration risk, and it's totally exposed to that currency drop. But now look at the right, a blended portfolio. And we're just talking about a simple 20% global allocation here. Does something pretty magical. The data shows it can actually reduce your overall volatility by around 15%, and it directly hedges that currency risk. And here is the real kicker. That simple move, adding just 20% of global markets, could boost your portfolio's overall annual compounding by an extra 2 to 3%. Now, that might not sound like a lot, but over 10, 20, 30 years, that small percentage makes a life-changing difference to your final wealth. So you get lower risk and potentially higher returns. It's a win-win. All right, I know what you might be thinking. This all sounds great, but isn't investing internationally a huge hassle? Isn't it really complicated? Well, let's break down just how easy your path to diversification really is for an Indian investor today. Let me introduce you to something called a fund of funds, or FOFs. Honestly, just think of it as your hassle-free ticket to the global markets. It's a normal Indian mutual fund, but instead of buying Indian stocks, its job is to invest in other big, established international funds for you. It handles all the complex stuff behind the scenes. And the process itself, it's ridiculously simple. It's literally just 3 steps. First, you pick a global index you want to track, like the NASDAQ 100. Second, you invest in a local fund of funds that follows that index. And that's it. Step 3 is that there is no step 3 for you. The fund manager handles all the foreign exchange stuff, all the complicated LRS paperwork. It's all done for you. So we've walked through the problem, we've seen the solution, we've looked at the data that backs it all up, and we've seen how simple the how-to is, which, brings the question right back to you. Are you missing out? Let's make this really personal for a moment. I want you to think about your portfolio right now. If the rupee falls another 20% over the next few years, and based on history, that's totally possible, what happens to the global value of your all-India portfolio? Will it shrink? And what about the flip side, the opportunity cost? What massive global trends, things like the AI revolution or the boom in renewable energy, what if those could be compounding your wealth way faster than the local market alone? Are you just sitting on the sidelines of the world's biggest growth stories? And finally, let's bring that number back. Are you okay with potentially leaving an extra 2 or 3% in annual returns on the table every single year just by staying 100% domestic? Just think for a second what that difference adds up to over a 20-year investment journey. It is a truly life-changing amount of money. If there's just one thing you take away from all this, I hope it's this simple but really powerful idea. Adding that global touch doesn't just diversify your portfolio, it actually globalizes your compounding engine. It puts world-class growth to work for you. Look, the data is crystal clear, and the path to get there is incredibly simple. So the real final question is, are you ready to take that small step to build a stronger, more resilient, globally powered portfolio? Are you ready to rupee-proof your future? Because the opportunity is right there waiting for you.